Ethereum had a massive problem, the gas fees. It's very expensive to use Ethereum, to just move it around or to use smart contracts, and Polygon Matic was the very first solution to that problem. Polygon Matic was the first broadly adopted layer 2 on top of Ethereum. So a blockchain on top of another blockchain, it was a revolutionary concept at the time. But it looks like over the years the excitement has come down. There are other layer 2s now on top of Ethereum. The question is, where does this leave Polygon Matic? In the last month, the Matic token, or POL, so that's the same token, just migrated to a new version. It went down by 11%. During the same time, Ethereum went down only by 1.6%. Now, this is not just cherry-picking data. It's not just looking at the recent 1 month. We actually see the exact same development if we zoom out. Here is Matic's performance in the last year, minus 66%. And yes, Ethereum didn't go up either, but it only lost 26%. So something is going on. Over the years, the Polygon Matic team has worked on quite a lot of technology. For example, there was the launch of the ZK Polygon blockchain. There have been several launches of decentralized finance applications. There's also been several bridges, right, asset bridges across the different chains. So in the end, the team decided to unify all of those projects in a single token, the POL token. This is where things really went south. Because when initially the Matic token launched in April of 2019, we had predictable token inflation. It was quite aggressive, as in the supply more than 3x'd in the span of 3 to 4 years. But then after that inflation, it seems like everything in terms of future selling pressure might be gone. But then came the merge to POL, and suddenly the ecosystem token became inflationary again. And this did not sit well with investors. It is noteworthy though that even though there is some token inflation, relatively speaking, it's not that aggressive anymore. So we are currently at a circulating supply of 10.3 billion. And 5 years from now, this will be at 11.4 billion. So really, it's not that bad. It's 2% or so per annum in additional tokens hitting the market. And so that then begs the question, is there potentially light at the end of the tunnel? Is there potentially enough usage or growth in usage for Polygon Matic that could justify the low inflation that could potentially push up POL long term? Now, on the face of it, it doesn't really look like this. This is the Polygon Matic total value locked over time. So it peaked at 10 billion at the end of DeFi summer, and then came the massive deleveraging event. But let's have a look at what's happening recently. Let's zoom in a little bit. Since October of 2023, so this is when money started to flow into crypto again, the TVL of the Matic chain actually went up from 800 million to now a bit over 1 billion. What's probably a better measure though to see how much activity there is to look at this total value locked in Matic or in POL tokens. Because POL itself is going up and down over time. And that of course has an impact on the total value locked on the chain as well. And measured in POL since October of 2023, we actually see quite nice growth. Very rapid growth from 1.2 billion POL to currently 6 billion POL. So growth of close to 5x during that time. Now, what caused this quick ramp up and subsequent decline? That was the presidential election in the US. You might have heard of Polymarket, right? A betting market on various events. A lot of people bet on either Trump or Harris winning. Once that bet was over, a lot of capital then left Polygon Matic again. But now Polymarket seems to be growing again. So the application continues to get adoption post the election. Here is a Polymarket TVL measured in POL over time. A massive spike, a subsequent crash as expected, but the growth has picked up again. What we are seeing here is the decentralized exchange trading volume measured in POL. Also, there tends to be some growth over the months. And here we've got the stablecoin market cap, also measured in POL over time. So all of those charts hint towards quite a bit of growth in Polygon Matic, and growth that might be stronger than the token inflation. Let's have a look at the POL token on the Ethereum chain. So we've got 61,000 holders, but not all of those holders are created equal, right? Some of them might just be arbitrage bots that just hold a few cents of the token. So we have to look at the details. What we see here on the left is now the number of wallets on Ethereum that have at least 5,000 POL tokens. So that's roughly $1,000 worth of the token. There are 3,200 such wallets. In the middle, we have a 10x in minimum holding. So it's now 50,000 tokens or $10,000 worth of the token. So there's now 800 such wallets. And on the right, another 10x, 250 such wallets with at least $100,000 worth of the token. We see accumulation across the board. We see very, very strong growth in the first few weeks. That was mainly a wave of migration from the old Matic token to the new POL token. That migration has now stalled. We don't see that much more purchases by small retail anymore, but medium-sized retail is buying. So are the whales. But really, given its size, given the market cap of Polygon Matic, it seems like there's not that much trading of the token going on. Because have a look at this. This is now the spot trading volume across various centralized exchanges. At number one, we've got only 5 million of trading volume in the last 24 hours. This is extremely low. Here we've got the perpetual futures market. We've got 17 million over here. But again, this is extremely low given the market cap of Matic. Nobody is interested in the token. It seems like attention is at a low, but that's potentially an opportunity, right? The idea is always to buy a token when nobody looks at it and to then sell it when attention rises. Maybe when there's a major event again, where people want to do a lot of speculation in the betting market, that could be a catalyst for POL as well. What I find fascinating is that the perpetual futures have mainly a positive funding rate. So the longs have to pay the shorts. It costs money to get more price exposure to Matic. At the same time, we do see some correlation between the POL price and the open interest on Matic. As in, when there's more speculation on the asset, the spot price tends to follow. When there's less speculation, the spot price tends to be lower. But the thing that's interesting here is that the funding rates are positive, while long-term historically, we have seen very weak performance of Matic. Now, this is the Matic US dollar chart. It starts at the beginning of 2023. And yes, there are sometimes our rallies here, right? This is a 160% rally, or this here is a 140% rally. But once we look at the exact same chart, relatively speaking, to Ethereum, the underperformance is very, very constant. Given such a chart, I'm surprised that the funding rate is positive. I would have expected more people to bet on falling prices and then potentially hedge that versus Ethereum so that we can make performance like this, right? This is a 10x roughly, plus 900% over the course of a bit over 2 years. In general, I think this is actually the way to make money for most altcoins right now. For Matic, we might see a turnaround because again, there is increased adoption and the token inflation isn't that bad anymore. But there are some tokens that continue to have very aggressive inflationary schedules and where the long-term price development looks very similar to Matic. Have a look at this. In the last year, Bitcoin went up by more than 70%, roughly 75%. But in the same time period, most altcoins, especially the smaller ones, tended to go down. So how many of those smaller altcoins actually made those 75%? It's 1, 2, 3, 4, 5. We've got 5 outperformers and 95 underperformers. And I think this is an opportunity. Most altcoins underperform Bitcoin most of the time because of token inflation. The team tends to cash out over time. Early investors tend to cash out over time. There is a growing supply with all of those vesting unlocks, and that then leads to long-term underperformance of most altcoins. And so that's how I'm currently making most of my money. This is how the community is currently making most of its money. So this is a chat where our members share their wins. We are betting on weak altcoins and we manage our risk, of course, in the process to outperform buying and holding Bitcoin. I've actually measured this for my own portfolio for the last 4 years. Had I just dollar cost averaged into Bitcoin, I would have gotten this light gray line in return. Instead, I got the black line because again, I shorted weak altcoins at the same time. Very inflationary altcoins where early investors cash out. And when they are cashing out, we are making money as well. A lot of this extra performance was because of Balancer. So that was one of my favorite trades. This is Balancer relative to Ethereum. Ethereum, just long-term underperformance with very little volatility. And so I just flipped this around and I got this performance instead. We go long Ethereum, we go short Balancer, and when we do these kind of positions for 4, 5, 6 different altcoins, and we manage the risk properly, we can have nice long-term outperformance without having to rely on the next 10 or 100x altcoin, right? We don't have to find the needle in the haystack. We don't have to figure out what's the next Kipchi or the next Aki or the next ZKML. We can just turn this chart around and everything that's red becomes green and everything that becomes green becomes red, but it's fine, right? We just have to avoid the assets with too much attention. Now, of course, I'm also making dedicated videos for all the premium members. Every 3 to 4 days, I publish a premium update videos where we discuss the positions we've got open, where we also discuss the general macro environment. There are many tutorial videos as well. And if you've got the time, you can just binge watch them and improve your crypto game long term. But in the end, really what matters are only 2 main videos right now. And that's how to bet on relative valuations and how to manage risk when doing that. Because that's the downfall of many beginners. They see suddenly my win rate is high, I'm winning in 70 or 80% of my trades, and so I can just increase my leverage, I can just be a bit more loose on the stop losses, etc. And then the few bets where it doesn't play out, where we actually have a green bubble over here and we bet on falling prices, those few bets then destroy the entire portfolio. So risk management is incredibly important. If you're winning 80% of the time, but in the other 20% you're losing everything, you haven't won at all. It's not a sexy topic, but please, before you start doing any of this, watch this video first. Risk management with relative valuation bets. It's 28 minutes. So feel free to join us. It's currently $125 per month. If you sign up for the yearly subscription, we can also have a one-on-one talk. So in case you want to discuss your entire portfolio, crypto, but also outside of crypto, then we can do this for 60 minutes in Zoom. We just then schedule an appointment. So that's over here, right? You're just toggling, you get to the yearly subscription. You're also saving $250 in the process. A link to the premium website should appear directly here on screen. Just click on that. It will lead you to the website. If it's your very first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in premium. Cheers.